Very good. Well, thank you, Angie. Appreciate everybody's time here on a Friday morning and look forward to being able to talk with you all for a few minutes about this topic. We are your friendly neighborhood auditors here at PYA, and as we go through the next 50 minutes or so, we will be covering an not-for-profit risk assessment update, which is SAS number 145. It's a new standard that will be effective for audits beginning later this year and next year. And just a quick introduction to ourselves. So again, my name is Matt Stuart. I'm a principal at PYA in our Knoxville, Tennessee office. I've been with PYA for going on 16 years now, and currently and over the course of those 16 years, focus primarily on our healthcare clients, both hospitals, physician groups, as well as healthcare for-profit companies and technology startups. And I also am in charge of the firm's employee benefit plan audit practice. And then joining me today is Connor Fitzgerald. Connor is a manager in our Kansas City office, and like me, he spends the majority of his time working with our healthcare clients, both not-for-profit as well as for-profit. So here is a very high-level agenda that we'll be going over today. And really, the purpose of this is if you are wanting a very, very nuanced and detailed discussion of all the new fabulous, wonderful things that are in SAS number 145. There are other good ones out there. This may not scratch that itch, so to speak. We're trying to approach this from the standpoint of not necessarily what is everything you would need to know about this new standard to conduct an audit. We're trying to convey the information of you all working for provider organizations and really being auditees. What do you need to know about this new standard? How is this going to affect your audit? And what can you expect as we again go into these calendar year 2023 and fiscal 2024 audits? What's going to be changing? What do I need to know? What are my auditors going to be asking me about? So we're going to start off here and just do kind of a general overview of this new SAS, some definitions. There's a new term in the literature called scalability that we'll discuss, and then we'll focus a large part of the presentation on the enhanced guidance surrounding general information technology or IT controls. And as Connor will explain here in a few minutes, that's really one of the biggest changes that's coming out of here is just the new IT environment, of course, and it seems like it's changing even faster than regulators can keep up with, and certainly AI and ChatGPT and things like that are increasing at such a rate those weren't even necessarily contemplated in this new IT realm. So certainly things are changing rapidly, and we would expect this to continue to be updated as the years go on. And then lastly, we'll summarize really our presentation by what do you need to do now to start getting your organization ready for future audits under SAS number 145. And I'll go ahead and just do a quick spoiler. The good news is it's not going to be terribly onerous on auditees. The main bulk of the work is going to be on the auditors to implement this new standard. So it's not something like the new lease standard that was just implemented, I think, for almost everybody over the past several years of having to almost go in and redo a large portion of your balance sheet to put leases on there. These are more just some subtle things kind of behind the scenes to prepare for. So did want to give everybody that bit of good news up front here on a Friday. And with that, Connor, I'm going to turn it over to you to kind of start walking us through the background of 145 and kind of move on from there. So.
Thank you, Matt. As Matt just mentioned, I'll cover some of the general background knowledge on this and then dive into some of the risk assessment changes. But as you know, today we'll be discussing Statement on Auditing Standards, or SAS we'll be referring to today, number 145. It's titled Understanding the Entity and its Environment and Assessing the Risks of Material Misstatement. SAS 145 will supersede SAS 122. 122 was last updated in 2011, so it's been a number of years since this guidance has been brought up to date. This standard was issued by the AICPA's Auditing Standards Board in late 2021. As a quick aside, for those not familiar, the Auditing Standards Board, or ASB, is the AICPA's Committee for Audit and Attest Quality Control. So the ASB is really the entity responsible for issuing the guidance that all the audit and attest services fall under that umbrella. See, SAS 145 will apply to audits and non-public entities, so essentially anything not subject to PCAOB requirements. And it will be effective for financial statement periods ending December 15th or later of this year. So for any calendar year end organizations, this will be effective for your 2023 audit. In the executive summary published by the AICPA for SAS 145, the ASB states right off the bat that SAS 145 does not fundamentally change any of the key concepts underpinning audit risk. And SAS 145 content-wise is one of the larger SAS updates I've seen. It's over 200 pages in length. That's, most of them don't approach that. Your first question you might be asking yourself is, why did the ASB issue such a large update if it does not fundamentally change any of our key risk assessment concepts? I have three main reasons why outlined here. I think will help answer that question. Probably first and foremost is that peer review programs are finding the risk assessment process was a common area of deficiencies in audits. For those of you not familiar, the AICPA requires that audit firms receive a peer review every 3 years. That just helps to ensure that audit firms are conducting quality audits in accordance with the AICPA standards. All audit firms are required to go through that peer review process, so receiving a peer review doesn't indicate any kind of issue with an audit firm. It's just a monitoring process that more or less everyone is subject to. But going back to that reason, those peer review programs were flagging that the risk assessment process was the leading cause of deficiencies in audit quality. It was causing deficiencies related to risk assessment were over 25% of all findings. So in response, the ASB put together SAS 145. So while it does include some new requirements in how certain aspects of the risk assessment are handled, like I said, it doesn't change any key concepts. It's really just highlighting things auditors were always supposed to be doing, and really emphasizing this is what should be done, this is how you should do it, and please make sure it's included in the audit process going forward. And there's some clarification in there too, and just other general areas that the AICPA wanted to place emphasis on and make sure that we're performing up to their standards. I think the second point of focus for what brought about SAS 145 was convergence with international standards on auditing. The ASB has a long-term strategic objective to converge US audit guidance with international standards, and the international standards updated their risk assessment guidance to be effective for 2021. So I believe the ASB used that international standard as the baseline or starting point for SAS 145 here, but did add in some differences and tweaks as they went towards finalizing this. A deep dive into those differences, I think, is beyond the scope of what we have time for today. But for anyone interested, the clarified statements and auditing standards, Appendix B contains a section outlining the differences between ISA 315 and SAS 145. That's pretty easily available online with the Google search. And then what I would consider to be the third main reason for the issuance of SAS 145 was to modernize certain aspects of the audit guidance. As previously mentioned, SAS 122, which this new update supersedes, was last updated in 2011. So that's resulting over a decade of changes to technology used in the business world not being reflected in the current audit guidance and terminology. So a lot of the changes in here relate to just updating wording and getting caught up to 2023 or thereabouts with terminology and process wise. So that's kind of a roadmap for how the ASB got here. Next, I'm going to get into what some of the main changes of SAS 145 actually are, but I do think having this background knowledge on how we got here is important context. Okay, this slide will serve as somewhat of a more detailed agenda on the main changes to the risk assessment process that came out of this new update. All of these items are areas of focus within the text of the SAS update. Being familiar with these topics, I think, will help any organization be ready for a future financial statement audit under the new standard. I think it can also provide some key points to consider when conducting your own internal risk assessment process, and even just internally developing internal controls and responses to those risks. So even if you're not necessarily coming at this from an audit perspective, I think there's a lot of good information in here that can help your organization. For those of you in the audience who are not familiar, or it's been a few years since you've gone through an audit risk assessment, I'm going to start with a high-level overview of what that risk assessment process is and why it's important to the financial statement audit process. From an auditor perspective, the overall concept is that the auditor needs to understand the background and context of an organization in order to do an audit before they can dive in and start doing testing and everything else that goes with that. That understanding will typically include market and demographic conditions of the auditee organization, competition, business risks facing the organization, and you also need to understand the motivations of management and governance, among other factors there. Using that information, an auditor can start to understand what the key objectives of the entity are, and then what key metrics are being used to measure those objectives, and internally, how is that organization making sure they're accomplishing their goals. Those factors can then, using those, the auditor can identify areas of high risk for material misstatement to the financial statements. At the end of the day, the goal is a financial statement audit. And then from there, we can work with the client to understand what key internal controls are in place to address those high risk areas. And obtaining that understanding of the organization's risk areas and the responses to those risks allows the auditor to develop the overall audit plan and then to go on and perform the audit. But just having that context, all of the items on this slide are key risk assessment factors covered by SAS 145. The first item is obtaining understanding of the entity's internal control system. That's one of the key pillars of the risk assessment process. We'll walk through what the ASB has emphasized there. There's not huge changes necessarily, but points to emphasis they're wanting to include for all audits. Next is internal control terminology. While not necessarily changing the key concepts of audit risk, again, as we mentioned, the SAS does add new verbiage. We'll hit the highlights from there. That'll be important for auditors and auditee organizations to be familiar with in order to stay on the same page when communicating. Next few items on here all relate to the audit risk model. We'll go over a refresher on what the audit risk model is. And from there, SAS 145 introduces a number of explicit new risk assessment requirements. I expect those might be of interest to anyone working in internal audit, especially. And then we'll round out the first portion of today's presentation with a new concept called the stand back requirement and some other updated guidance on the requirements for when an auditor is required to communicate internal control deficiencies with management and governance. Moving on to that first item here, throughout SAS 145, there is a significant emphasis placed on understanding an organization's system of internal controls, that being an integral part of the risk assessment process. The update goes on to state that the components listed out here on the slide need to be used when understanding and evaluating that system of internal controls. if anyone remembers from their accounting classes in college or perhaps studying for the CPA exam, you might recall the mnemonic crime. I learned it as it would be a crime to forget the components of the internal control framework. That's essentially what we have codified here now via this updated SAS 145 guidance. But regardless of what mnemonic or what trick you use to remember these items, we need to use these. We need to obtain an understanding of each of the 5 items here as the first pillar of our understanding of the internal control process. The first item listed is control environment. I think of this as the tone at the top, if anyone's familiar with that term. It's essentially what policies and procedures has management and governance put in place to exercise their oversight of the system of internal controls. That's going to include how an organization assigns responsibilities to employees, how an organization attracts, develops, and retains competent employees, and how employees are held accountable for their responsibilities. The risk assessment process is the next piece of mnemonic here, I suppose. That is how an entity identifies risks that could impact financial reporting, assesses the significance and likelihood of those risks, and then finally addresses those risks. That would be comparable, I would picture comparable with an internal risk assessment if your organization is already preparing one of those. Monitoring the entity's process to monitor the system of internal control, that is, boils down to tracking the effectiveness of controls and how you respond to control deficiencies. So if something goes wrong at the internal control level, how does your organization identify and address that breakdown? Fourth piece mnemonic is information systems and communication. That all involves understanding the process surrounding how transactions are initiated, recorded, processed, and ultimately make their way into the general ledger and financial statements and financial reporting. Typically, IT will be involved in that process, so we'll discuss IT controls later on in the presentation, as Matt mentioned. And finally, control activities. Those are the internal controls themselves that address the risk of material misstatement. Combined, these 5 factors serve as a groundwork for the rest of the risk assessment process. The nature, timing, and extent of all audit procedures will be driven by the results obtained here. However, SAS 145 is principles-based. Because of that, the degree to which the factors might affect that method, apologies. The degree to which these factors might affect an audit methodology will vary based on the particular approach, tools, and techniques. So there is a lot of leeway in there while still using this new framework to tailor the audit to the specific entity and the results of the risk assessment. Also new with SAS 145 is it gives us a new terminology. I think it would be useful for everyone involved in audit to be familiar with. Throughout all the AICPA's generally accepted auditing standards, the term internal controls has been updated to system of internal controls. That one's fairly straightforward, but you might start seeing that around. And then the term controls has also been clarified to mean the policies and procedures that an entity establishes to achieve the control objectives of management or governments. And in that context, policies are statements of what should or would not be done to effect control, and procedures are the actions to implement those controls. So in plain English, I think of that as, controls are the steps an organization takes to ensure tasks are performed as designed. I've highlighted just 2 what I thought were the most important terminology changes here. Within the full text of SAS 145, specifically paragraph 12, there's several pages worth of definitions. Some have been updated, some have not been changed from existing guidance. While I don't think we have time today to go through all those, while I don't think we have time today to go through all those definitions, I would encourage anyone interested to go out and take a look. I'm now going to hand the presentation back over to Matt to take us through what SAS 145 means for the audit risk model.
Yeah, thanks, Cotter. I appreciate it. All righty. So as Connor mentioned, if you happen to be a CPA or a recovering auditor, or even just took an audit class in college, some of this will be a little bit of a review of things that, maybe you haven't heard in years, or if it's something you're hearing for the first time, it's kind of a peek behind the veil, so to speak, of the audit process. So I know that's, everybody likes behind the scenes stuff, so you can buckle in certainly and get ready kind of while we take you behind the scenes of the audit risk assessment process. But just to start off here, just wanted to kind of go over some terms. And again, I would suspect a lot of you have heard these before, even if you don't quite remember how to place them. But first off, just wanted to define what audit risk is. And this is, again, more for us as auditors of how we have to come up with the overall risk as we get started on an audit. But an audit risk is basically a formula that takes inherent risk times control risk times detection risk, and basically gives us, hey, here is the risk score for this. So inherent risk is the name would imply, how inherently risky is an item in the financial statements. Again, we're focusing on the financial statement audit. So a couple of examples here, again, just to illustrate inherent risk. There's several ways that can come about. One thing in healthcare, of course, is the accounts receivable model and estimation process is extremely complex and just includes volumes of data, but it's also almost always material to the financial statements. So when you look at something like that is both material and it's inherently complex and includes a lot of estimates, the inherent risk associated with accounts receivable for a healthcare organization is almost always at a very high level. Another way to look at inherent risk too is, is there an inherent risk that it could be subject to theft? So, to make up a silly example, if the cash every night was, not locked in a safe, it was just put in a drawer, well, that would be inherently risky because it's going to be easy for somebody to steal it. Now, for something that might be material to the financial statements, but is not easily either stolen or not susceptible to estimates, one thing to think of there might be something like property, plant, and equipment. Because again, you may have an MRI or a CT scanner that could be worth millions of dollars. However, the likelihood of it being stolen are pretty low. It's more than likely bolted to the floor there. And also, typically the value of those isn't subject to any type of estimates. You put it on the books for what you paid for it, and then of course you evaluate it. If there's any impairment, you write it down. But it's not something that's going to involve a lot of calculations or a lot of estimates. So that's just a very quick run through of what inherent risk is. And then control risk is the risk that an organization's system of internal controls will not prevent, correct, or detect either fraud or error. So you think about internal controls, for example, an easy one just to illustrate would be a bank reconciliation, right? So you're going through the bank statements every month. Somebody's doing a reconciliation from what's on the bank statement back to what's recorded on the general ledger. And in a perfect world, this would include segregation of duties to have somebody that's reconciling the account that is not a signer on that bank account, right? They couldn't write checks, so they've got less rationale to want to hide things, as well as having a second party also review that bank reconciliation behind them. And then lastly, detection risk that's kind of where we come in as auditors. It's the risk that the audit process would not detect the fraud or error. So SAS 145 does make some changes to this risk assessment process. And again, this is mainly going to be on the audit side, but just wanted everybody to have familiarity with it, just if you hear the auditors talking about it, or especially if they ask more questions or different questions during the 23 audit and going forward. This is likely the reason why is they're just making sure they have their bases covered as it relates to these new risk assessments. So the first thing just to mention is that, so there is a concept here also in the auditing literature called the risk of material misstatement. And what that means is we have to assess the organization's overall risk of material misstatement by individual area. And what that entails is it's just the first part of that formula. So it's inherent risk times control risk. We don't include the detection risk because this is before the auditors ever come in. So this is just, hey, on the surface for accounts receivable, what's the risk of material misstatement there? It's the inherent risk times the control risk. So what auditors were able to do in the past is, instead of having to go in there and say, okay, what's the inherent risk of this area? What's the control risk? Let's get our total risk of material misstatement score, if you will, and typically that's assessed at low, medium, maximum, those type of tiers. Now it says that, well, no, you can't just go in and give an overall risk of material misstatement rating. You have to go in individually and evaluate these. So auditors going forward are going to be required for every area to not just give an overall score. They're going to have to go in and make sure that they document what is the inherent risk of this area, what is the control risk of this area. So again, probably not a significant change. I know for, here for all of our hospital clients, and honestly, really for any organization of any size, my suspicion is that your auditors are already doing this. So I think this may just more be some documentation change on their end, but don't anticipate this having a large effect on, especially on the types of organizations that are on this call, to anybody's audit process. We just wanted everybody to be aware of it, that this is a change. Another change to be aware of is what's known as a revised definition of a significant risk. So in the past, there was a concept in the auditing literature called significant risk, which really could go along a lot with the auditor's judgment. They could say, okay, what are the significant risks to the financial statements? And a couple that are almost always there are around revenue recognition, and then of course, management override of internal controls. What is changing to now is kind of a different term, which is called identified risk. So in a lot of respects, it's very similar to what we've always kind of just called a significant risk. The real difference here, just to illustrate, is that an identified risk is a little bit more, what I'll say, I guess, objective as opposed to subjective as opposed to objective. Mix those up. So in the past, it was a lot of auditors' leeway and discretion into what made up a significant risk. With this new standard, what it says is that anytime there is an inherent risk that's assessed higher on the upper end, that automatically defaults to it needs to be considered to be an identified risk. And the last couple of things to point out here is that control risk plays no part in whether something is an identified risk. It's strictly related to the inherent risk. So if something's inherently risky, vis-a-vis accounts receivable, like we talked about, more likely than not, the auditors are going to deem that to be an identified risk. So again, a lot of it's more just wording changes and terminology changes on our end. Don't anticipate this having a huge impact on everybody, but really just wanted to illustrate that change in terminology, because you will hear probably that going forward, especially in the planning phase of an audit, when your auditors are trying to identify and talk about, well, let's talk about identified risks. And you may be like, wait a minute, I thought this used to be significant risks. It's a change in terminology. I don't think it's a huge change and really what's going to be evaluated, but did want everybody to be aware of that change in terms, just as you hear it going forward, sir. Okay, a couple of other shorter things to mention here. One is, and Connor, I think, teed this up great a second ago, SAS 145 introduces a new stand-back requirement that's intended to give an evaluation of the completeness of the auditor's identification of significant classes of transactions, account balances, and disclosures. So again, what this means for you all as auditees, probably I would say negligible to zero impact. Really what that's going to entail is kind of, before an audit is finalized, it's really codifying and formalizing the process that we as auditors are supposed to say, okay, we planned our audit, we did all of the assessed risks, came up with a risk and material misstatement, move forward from there. We did the audit, we're about to finish things up. Before we issue, as the name implies, let's pause, let's stand back, and you kind of picture somebody going up on the top of a hill to survey a battlefield or something like that. All right, before we wrap this thing up here, let's look out and see, are our assessments that we made at the beginning of the audit, are they still relevant? Do we need to go in and change anything? Has anything changed as a result of the audit? And if so, are additional procedures or inquiries needed before wrapping up the audit? So again, that's more on the audit side of things, and that's already been in there in the auditing standards to some extent, but I think this just does a better job of fleshing out exactly what the AICPA expects of us as auditors to do before an audit is finalized. And the last thing, again, not to spend a large amount of time on because I don't think it will have an impact, it just introduces some new explicit requirements related to communicating identified control deficiencies. If everybody recalls, the two types of internal control deficiencies that auditors are required to communicate in writing to those charged with governance are material weaknesses, which is the kind of the top level, if you will, of an internal control deficiency. And then the second or mid-tier, which is a significant deficiency. So those are the two that are required to be communicated to the board or those charged with governance, and it needs to be in writing. The kind of the least of those is just a regular deficiency, and those are required to be communicated to management, but they don't have to be in writing. They can be, or they can just be orally communicated. So SAS 145 just codifies and tries to tighten up some of the standards over the years that have come about communicating those identified control deficiencies, and really just try to kind of tie everything together into a little bit of a tighter package about what needs to be communicated and when. So again, nothing that's really going to require any preparation on your part as auditees, but just know that that's out there, and potentially some of the requirements, it could lead to a little bit different communications coming forward, but nothing that should be significant, sir. And with that, I think that brings us to our first polling question, Angie.
Terrific. Matthew, if you will open up the polling question. Our first polling question of our last session is, which of the following is not a component of an entity's system of internal control? The control environment, the entity's risk assessment process, stand back requirement, the information system and communication, or control activities. You'll have a few moments to answer the polling here. And just remember that we are doing this for CPE credit for our CPA attendees today. If you're having any problems answering the poll question at all, please put your answer to the poll in the questions pane within GoToWebinar, and we will submit that to our CPE reviewer instead of monitoring your engagement via answering the poll virtually and not through the control or the questions panel. Looks like we have almost a pretty good number. All right, moderator, if you will release the poll and the answers to Matt and Connor. Thank you.
All righty, well, very good. 72% got it right that it is the stand back requirement. While that is an important factor that auditors are going to consider going forward, it doesn't kind of make up those key components of internal control that Connor was mentioning a second ago that kind of make up that CRIME acronym. So well done, everybody. Your accounting professors, wherever they may be, are very proud of you at this moment, I'm sure. All right, last thing I'll touch on here before turning it back over to Connor to continue to go over some topics is a new kind of I guess definition in the standards called scalability. So of course, scalability, I did look this up beforehand to make sure that this is a real word, because it's one of those that I think that sounds like a real word, but I've never really heard it. It is a real word, but it's its first appearance in the auditing literature. So yay, we get a new term to define here. So what that means is that going forward under SAS 145, an auditor is going to have the flexibility to scale kind of the size and documentation of their risk assessment based on the entity. And what this does is it replaces, if you look at the second bullet point, it replaces an existing standard called Considerations Specific to Smaller Entities that was included in the risk assessment guidance. And you may be thinking, well, wait, that doesn't sound good. We, want smaller entities to be able to be, kind of have the flexibility to, potentially have less formal documentation of their internal control processes. And really what this does, though, I think, is do a better job of defining exactly what the AICPA and the standard setters really were trying to get at with this risk assessment documentation, in that it's no longer necessarily based on the size of the organization, but it's really based on the complexity of an organization that's going to determine the auditor's judgment about how, the level of detail that needs to be documented as far as the internal controls and the risk assessment process. So this means that potentially there could be a fairly large organization, but that, maybe it's not terribly complex, and there's even a chance that some of the documentation around the risk assessment process could be streamlined under this new standard. Just again, recognize that just because something is big doesn't necessarily mean it's complex. And then kind of on the other side of the coin, as you might have guessed, just because something is small doesn't mean that it's necessarily simple. You could have a small organization that, is incredibly complex, whether just due to the nature of the business they're in, their ownership structure. You can fill in, a lot of blanks there, I'm sure. So it really tries to make this applicable really just based on the complexity of the entity more so than its size. So again, I think this is a move in the right direction to be able to, scale, if you will, the size of the audit response to the organization. And if you'll bear with me, the standard does give a couple of, or several really good examples of just how this can go about. So just kind of reading here, just a few examples out of the standards, it says that potentially auditors can observe segregation of duties, even if no formal written policy outlining them is in place. So again, that gives to the spirit more of saying, hey, just because we all know, just because you have a policy in place, that doesn't mean that necessarily it's being followed. But if an auditor can observe the segregation of duties, potentially that would meet the requirements of this new standards. It mentions a control environment governance. It says again, the guidance mentions a less complex entity may not have a written code of conduct, but based on inquiry and observation, the auditor may be able to get a sense for the overall culture at the company. For monitoring, you can look at how management is directly involved in the operations. And finally, for communication, a formal manual may not be needed for a less complex entity. Auditors are able to observe that open communication channels are in place if the manager is accessible. So again, it does try to illustrate that for less complex entities, and particularly those that are owner-managed entities, just because there is a lack of formalized process and controls does not automatically mean that there's some type of control, either deficiency, significant deficiency, or material weakness. Now, that's not to say those still may not exist, but it kind of removes one of the barriers. Well, yeah, but you don't have it documented, so that's a deficiency right there. So again, this is really based on the perspective of an external audit. But one thing just to mention as far as this goes is, especially in organizations that maybe have an internal audit function, this is something that I think that internal auditors are going to be, looking at as well when they're doing their documentation and procedures, is just the scalability aspect now that's being introduced into the literature and into the standards, to not necessarily say that it's a one-size-fits-all approach. It's really just about the organizations, the level of management involvement, and of course the complexity of things. So with that, I think we're going to actually go into another polling question. Yes, there we go.
Terrific. Moderator, if you'll open up the second polling question of this session. Under SAS 145, the concept of scalability is based on which of the following? The entity's number of employees, the entity's complexity, the entity's number of locations, the entity's annual revenue. You'll have a few moments to respond. Thank you for participating in the poll. If you have any trouble at all, please use the questions pane to reply, to provide your answer, or to let us know that you're having trouble. Then we'll submit that to our CPE reviewer and note the time of that in order to review and secure your CPE credit. We're going to pause just a second and try to get a few more answers in before we close out the poll. All right, very good. Moderator, if you will close the poll.
All right, well, outstanding. It's based on complexity. I know I mentioned it a few times, so thanks everybody for paying attention to me. That makes me feel all warm and happy inside that you all realize that the new scalability aspect is going to be related to complexity. So with that, I'm going to turn it over to Connor, and he is going to walk us through some of the changes related to IT controls.
All right, thank you. The third main area that SAS 145 provided updates for relates to general information technology controls. As I think Matt and I both mentioned a few times now, this SAS is updated information that last had a big overhaul more than a decade ago. During that time period, the prevalence and importance of IT controls in an internal control environment has increased significantly. So given that, the ASB has provided us with updated terminology and then also some new IT requirements to help with modernizing the audit standards to catch up with where the business world is now, for lack of a better word. I wanted to start by excuse me, highlighting a few important terminology updates. There's two new definitions here. The first is risks arising from the use of IT. That is going to be how susceptible are information processing controls to ineffective design or operation. So essentially the risk the IT system is putting out bad data, or the risk that the information processing controls are not set up correctly. And the second definition is general information technology controls, defined as controls over the entity's IT processes that support the continued proper operation of the IT environment. Examples might be firewalls, passwords, backup and restore processes, even just access to a server room. But combining that risk, that new risk we want to focus on, with these new controls to address that risk, we can identify areas that as auditors would now be required to look at under this new standard. And I think internally within your organization, it can help you all too with identifying which controls you want to key in on that are addressing key risks and give the most focus to. Beyond just terminology, beyond just terminology changes, SAS 145 introduces a new explicit requirement that the auditor identify IT controls addressing the risks arising from the use of IT. And also, we are now required to evaluate the design and determine that those controls have been implemented. And you may be saying that sounds like what you already understand your auditors were doing. That same set of requirements were already required for non-IT controls, just for general internal controls for, say, an accounts payable process, that type of thing. But now written into guidance, we have to take this a step further and identify the IT controls that fit into that same system. I do want to identify that SAS 140, do want to emphasize that SAS 145 does not require an auditor look at every IT general control for every IT application, for every assertion. As with everything under this SAS, you take a risk-based approach and only look at key areas. From a practical approach, I've been thinking about this as a three-step process. Now, I might approach this from an external audit perspective, but I think the same approach could be used within an organization to perform your own assessment or just to generally improve internal controls surrounding IT here. So step one would be essentially perform a traditional risk assessment on the risk of material misstatement at the assertion level. When you identify a high risk assertion, you would move on to step two, being to analyze which IT applications affect that assertion that we identified in step one. From there, step three, you would then obtain an understanding and determine the implementation of those IT controls for the application we identified in step 2 for the assertion we looked at in step 1. I saw a good example of this that I wanted to share. It's very simple, but I think that the point will help illustrate. But say we're considering the occurrence assertion for expenses. Did the underlying transaction related to that recorded expense actually occur? The overall control here might be that a payable software requires a 3-way match before allowing a disbursement. The example, in this example, the IT application would, for the occurrence assertion, is going to be that payable software. As part of an audit walkthrough, I'll touch on those more in a second, but as part of a walkthrough disbursement process, under SAS 145, we need to take that step further and look at general IT controls of that payable software. So in our very simple example here, we might just observe that the software has password requirements in place to access the application. Going into that scalability discussions from a few slides ago, at more complex entities, you're obviously going to take this further. You might also want to understand the network and databases connected to the IT application and how that data flows from the IT application then into the general ledger. A decision on how far you take that understanding is going to tie into the scalability, like I already said there. Where I think this might change, where as an auditee organization you might see the biggest change, might be to the walkthrough process. A walkthrough is typically what an auditor will use to obtain an understanding of controls. You might take a process such as payables or payroll and walk through that process, sit down typically with people in the organization whose day-to-day job involves working on disbursements or payroll, whatever you're walking through. As auditors, we observe what the process is and then observe that the key controls outlined in the policies and procedures are in place and being used by the person performing those duties. So the change here is that the scope of that walkthrough is now expanded, where when we're sitting down with an organization staff going through that process, beyond just looking at general, internal controls, segregation duties, that type of thing, now would also be looking at the IT controls that impact that process. So that is going to be the biggest change I think you might see from an auditee organization side. Appendix E of SAS 145 is titled Considerations for Understanding IT. I think it's just a great resource for additional information related to implementing these new IT requirements here. I will say the full SAS 145 is available for free on the AICPA's website, and all the appendices are included there if anyone would like to access that information at a future date. But specifically, this Appendix E is about 10 pages of factors to consider and examples of examples of what you want to look at as part of this IT process. One item the Appendix E discusses is how manual or automated elements of IT controls can impact risk assessments. The guidance indicates that automated IT controls may be more reliable than manual because they cannot be bypassed or ignored as easily. Automated controls are also less prone to simple errors or mistakes. So the guidance goes on to say that automated controls might be more effective than manual controls for situations involving lots of high volumes of recurring transactions. It's not necessarily groundbreaking stuff, but I think it's just really useful to read. It's a great summary to help understand how to actually implement this and what it might look like in a real world example, as opposed to just accounting terminology and accounting language, sort of a plain English approach. Another area in there in Appendix E is emerging technologies. It recognizes that newer technologies like maybe blockchain or robotics or artificial intelligence might begin or already might be used assisting with financial reporting. The guidance gives some information on how you can incorporate those more complicated new technologies into this process, and the considerations I think would be useful to both an auditor, but also for internally at an organization conducting your own risk assessment to make sure that you feel good about your IT controls being set up correctly, even if you're branching into newer technology. Scalability is addressed in Appendix E. Matt gave us a great example, but just wanted to touch on a couple more ways scalability can be incorporated when considering IT controls. As always, the extent of the audit procedure is going to be driven by that complexity, just as they would for non-IT controls, but some indicators of complexity of an IT application or situations where the extent of the audit procedures would need to increase there might be how well established and reliable is the software. Obviously, a more established software would require lesser procedures than something produced by a new startup company. To what extent can the auditing organization modify the source code of the software? Again, something highly customized is going to be more complex than software straight out of the box, which allows no customization. You could tailor your controls to that level of complexity again. Another example involves what happens to financial data between being processed by an IT application and being used in financial statements. If that data is manually adjusted and changed, as opposed to a system-generated data being directly incorporated to the GL, that manual adjusting process might add a step of complexity, especially if there's additional calculations to something that came out of a database before it can go into a GL. Volumes of data processed impacts complexity. Obviously, more data is generally more complex. Other indicators of a high complexity might be a third-party company hosting the software. That can add on a new layer there. Let's see. Appendix E, just want to wrap a few more things, also provides examples of specific situations that would indicate an IT application is subject to high risk. Going all the way back to our definitions a few slides ago, these high risk applications are where you're going to have the high risk from using IT and then have to do the walkthroughs and the additional work there. But a few examples of high risk applications would be when you have multiple applications interface together, when an application processes a significant volume of data, when an application that automatically initiates a complex transaction, that'd be high risk. And if management places a lot of reliance on an application for financial reporting, that can be high risk too if there's not other controls to ensure you're still getting good data. At the other end of the spectrum, Appendix E provides lower risk examples too, typically opposite. Standalone applications not connected to a database or other applications, low risk, lower volumes, as we've said a couple times, lower risk. And then a situation where transactions are still supported by hard copy or secondary data outside of the IT application are considered lower risk under new guidance, because essentially there's another way to test the integrity of that data if there's something else to go back to. Just consistent with Appendix E's title, it contains a lot of good considerations for understanding IT. It's only about 10 pages in length, and I think if you're going to read one piece of the whole SAS, I'd probably recommend Appendix E. And now I'll hand it over to Angie for polling question number 3.
Terrific. Moderator, if you will open up the poll for us. Our final polling question is, which of the following characteristics of an IT application could indicate increased audit risks? Is it standalone IT applications, process transactions supported by original hard copies, low volumes of data are processed by the IT application, or management relies on an application system to process data? You'll have just a few moments to answer the poll question. As a reminder, if you're having any problems at all, please put your answer into the question pane, and we'll submit that to our CPE reviewer. Moderator, if you'll release the poll.
All right, thank you. Yes, standalone applications was our answer there. And I think I'll now hand it back over to Matt to discuss what an organization can do now to get ready for an audit under this new standard.
Yeah, thanks, Connor. And this is kind of just the wrap up of our presentation. I know we're right at the end of our time. Really appreciate everybody's attendance, and I know especially for those on Eastern time zone, we were competing against probably the start of your lunch hour. So again, as fun as auditing standards can be, certainly hard to compete with lunch. So just really briefly to kind of wrap this up here. Again, just as far as your organization preparing for SAS 145, we just make sure that your internal risk assessments, not necessarily that they need to conform to everything we've talked about today in your SAS 145, but honestly, I would just use this as an opportunity to make sure that those are updated, to make sure you have them, make sure that they're being, looked at on some sort of regular basis. It's great to have something, but if it hasn't been updated since 2012, it's probably, not going to help you very much when it comes to the audit. Like Connor discussed, certainly take a good look at your internal control policies and procedures to address key IT processes. That's probably the biggest takeaway from this, is really focus on your IT process and how you can improve your documentation around there, because when this standard is effective for auditors, we will have to make sure that we are including our IT professionals in the audit, honestly, to probably a greater, even more thorough extent than they are now. So that will be an area of focus certainly going forward. Additional internal control testing and walkthroughs will be done by the auditors potentially. So certainly internal audit may need to look at that. And then last but not least, just being familiar with this new terminology and knowing that it's out there. And when you hear some of these new terms, even if you don't remember what we talked about today, hopefully it'll just be in the back of your mind that, oh yeah, I remember there's something about this. Let me, put this into Google and see what it says about it. So with that, I know we're at the end of our time, but that is the end of our presentation. I'll give it back over to Angie to close us out. But again, thank you all so much for your time, and hope you have a great rest of your day and a good weekend.
Thank you, Matt. Thank you, Connor. And thank you to all of our attendees. We really are so thankful for your attendance and hope you enjoyed the two-day Summer Symposium. When you close out of the webinar today, you will be receiving a survey, and we would love to hear from you. We want to hear your likes, dislikes, and other comments along the way. It helps us to always improve. Also, just again, wanted to offer the opportunity to reach out to us with any questions that you have regarding our sessions over the past couple of days. Happy to answer your follow-up questions. Your CPE certificates will arrive in about 6 weeks. And if you have any trouble with that, please reach out and let us know if you don't receive it. So thank you so much. Have a great weekend. Thank you for spending your Friday morning with us. Take care.